I just had to sneak out of this conference I'm at and snag a beer. Bored halfway to death. Well, I am at a conference here in Marina Del Rey at the Ritz-Carlton. There's a bunch of yachts over to my left here. It's we're among the fancy people, but clearly I got a Boston Lager. I'm clearly not the most fancy guy here. But today's video, I wanted to update, give a sneak peek of 64 slides from KKR, highlight just maybe 5 or 10 what's going on in the alternative asset classes, assets, private investments that are going to certainly outperform, at least on a historical basis. We can forecast that the growth rates here are higher than public equity returns. Then we're going to look at what would happen in the scenario that there were a credit crisis, a liquidity event, some type of financial apocalyptic event. How would you be prepared for that? What would that look like? Would you be the person buying cheap assets in a position of relative strength, or would you be doomed? And then, of course, we're going to look at public markets. So there's, as always, timestamps below if you want to skip around, be my guest, and let's see what we can do here. And then I better get back to that conference, huh? Let's start with a broad question here. How are capital markets looking? You would want to know that if you were about to get into some private equity deals, wouldn't you? So going back in time here, you can see July 2021. This is like when Cathie Wood and the ARK and the meme stock and the growth stock performance really crescendoed. Then we seem to have bottomed with the interest rate hiking cycle. That's July 2022. And now we are rebounding. Same spot we rebounded in April of 09. Okay, we're now turning up. From July, it's a couple months later, but from July, looking pretty healthy. Okay, so liquidity conditions are about to increase. Federal Reserve just reduced interest rates. That's a theme among central banks around the world. So let's do some deals, baby. And I know a guy who's up for election who's just happens to write the art of the deal. So if we're doing deals, hey, I like privates to outperform. Now from KKR, the growth of alternative in U.S. trillions. Let's just move myself out of the way there from 2018 to 2022, and then what they have forecast through 2028, which gives us a compound annual growth rate in this right side here. Private equity, 13%, nothing to sneeze at. Venture capital coming in at 19.4%. Very good stuff. Hedge funds, I have a special place in my heart. I have a hedge fund background, long, short, equity, currencies, commodities, you name it. Um, but I'm not the type of person to lump in hedge fund performance with the privates. I'm looking more at the like private debt, private real estate, infrastructure, natural resources. You could get into like the renewables, and you could get yourself secure with some hard assets, some agricultural commodities, for example. But private debt, okay, this is another one to think of. 14.5% in compound annual growth rate from 2018 to 2028. And this is certainly going to grow now that interest rates are coming down. The risk-free rate, if it goes to 3 or 4%, obviously you'd want to do 4 or 5x that, wouldn't you? So these are growing asset classes, and they have been democratized. If you're not in it, talk to me, baby. The high net worth allocations, 7.7% as recently as 2020, up to 9.1%, now 9.6% as of this year. Gonna probably get into the double digits. Cheers for that. I mean, wouldn't you want an allocation to something that outperforms? I would. I'm not even going to edit this. You're going to have to actually wait for me to sip a beer. The family office sleeves as of 2024. I just like to highlight this. You hear about the 60/40 portfolio, 60% being public equities. Only 28% here, family offices. Family offices tend to outperform. You can do this too. You don't got to be too fancy, too sophisticated. You don't even have to have a yacht parked out there in Marina Del Rey. The insurance survey, the net percent of survey respondents planning to increase or decrease allocations. Cash. Put cash to work. We've made videos about putting cash to work. This was as recently as March of 2024, so they've participated in some upside. Public equity is only 5%. Bank loans and high yield, okay, if you can lock in something decent. But infrastructure, we talk about infrastructure all the time. Private equity, private credit. What's not to love? Pension funds, another major allocator from 2001. You can see let's just get the head out of the way. From 2001 to 2010, 2020 to 2022. We're going to get some updated data here. You can see private equity and private debt, 4%, 13% now. So a couple decades later, more than triple. Real estate has increased, equities has increased, fixed income has decreased. Okay, because we're more interested in the privates that pay us a higher yield. Equities here in blue, I assume these mean public equities. So getting smaller because we can seek outperformance elsewhere. That's really all there is to it. Now, to transition here, well, let's talk about this asset allocation as a percentage of assets under management by type of allocator: pensions, foundations, insurers, family capital. You can get a sense here: credit in yellow, equities in gray, cash in this neon or this aquamarine blue, alternatives in this like yellow, orange, gold. 52% for the alternatives for family capital, and family offices tend to outperform. So, take a page out of their playbook. But okay, now to make a segue here, insurers, insurers, they have a lot of assets through insurance policies, through annuity contracts. I mean, if a ton of people died who have insurance payouts, that would be something, eh? I mean, these death benefits. But think about this: their allocation to credit. If we were to have a liquidity event at this point, think of the liabilities that would be unfunded at that point. This is something that is really crazy to think about. Insurers, they need to be an A plus 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 with the credit raters, the credit bureaus. If there were to be some type of systemic financial event, that is something that every once in a while keeps me awake at night. So let's think about that in moving to the next topic. What would you do in a scenario where the wheels fell off the global financial system? Right here is one of those pieces of trivia that feels like just a throwaway item until you really start to think about it. 1931 and 1969 were the only other 2 years between 1926 and 2022 where you had a sell-off of the bond market similar to 2022. 1931, you might remember, was a couple years removed from the Great Depression. 1969, you might recall, similar to the current stagflationary concerns that some of the doomsdayers have been bringing up. The 70s brought on a horrible, horrendous period of stagflation where rates were between 10, 15, 20%. We haven't had these wheels falling off type dynamic just yet in 2022, but it takes a while for those types of events to materialize. You can see all these other data points. It's just these three, and you had a bond market perform as poorly as it did in 2022, and that creates vulnerabilities. We had the Nixon shock. Okay, so it was 1972 when he took us off the gold peg. You started to see the introduction of fractional reserve banking. You saw the dollar just get wrecked. They had to take the dollar out with Old Yeller and start printing money. It took a while, though. It was 1969 that you had the bond market perform as badly as it did, not until 72 where you had the quote-unquote Nixon shock. So what about 1933? Okay, so it was the Depression in 29. It was the bond market malfeasance or underperformance in 1931. And then not until 33 that basically they confiscated your physical bullion, your gold, and they gave you an IOU. So, hey, thanks for the gold. We'll give you a piece of paper. It takes a couple of years. Okay, so it's been a couple of years. We're starting to look around like, are we prepared for this type of scenario to play out again? We're thinking about. Simply put, there is a world that you hope for, and there is a world that you prepare for. I think a lot of people are jaded by zero interest rate policy and the idea that assets only ever go up in price, that it has people with an inflated sense of confidence about future prospects. To be clear, I'm always focused on the upside. I'm a big believer in entrepreneurialism and private enterprise finding solutions to complex issues and driving us forward. In the same way that I do have insurance policies, a term policy, disability income policy, variable universal life insurance policy. I've prepared myself for catastrophic, well, I should say, I am never going to experience catastrophic loss because I have insulated myself from it. And part of that is about being prepared to have optionality in a worst case scenario type event. Just to give you some stuff to think about, I have residency in other countries. That is going to give me a leg up if I'm trying to book a flight and I'm in a jam. I have contacts with people I can reach out to in other parts of the world who can facilitate and support and help me. I won't be in a last minute visa application process. I'll be able to get a move on. And just want to highlight, I've spoken about Singapore recently. I'm going to highlight Dubai here, the United Arab Emirates. This new idea of an international dream, not so much the American dream, but places where you get treated better, better tax rates, more favorable banking conditions, decent cost of living, good culture, good lifestyle. It's worth considering. That's really all I'm going to say about this. We can talk about it in more detail if you email me or give me a call. Just to say, if there's panic in the streets, do you want to be the person who's freaking out about it, or who's feeling like, hey, it's always paradise? And when there is panic in the streets, I'm the guy buying up cheap assets. Last but not least, on to the public markets. Let's look at the SPY ETF for the S&P 500. I think you've got a pretty clear indication here of what you need to do if you're looking to make a big move. See what happens here. The previous resistance, we came up here back in July and August. We failed as recently as August, September, failed, and then we broke through. So let's see. If we hold support here, we're probably going to go higher. If we lose it, we're probably going to go lower. But we could just go sideways until further notice. I am catching on the Chaikin here. We had caught this move up here back when we were around 515, 520. We caught this curling up. That was a good long entry. We came up here, you could have taken some profit and then repositioned here on the higher low. But we are now seeing a bearish divergence on the Chaikin oscillator here. So, not a lot you can do until you get confirmation one way or the other. Some potential overbought signals here. We're seeing and we saw it here as well, on the MACD and RSI when we came up to the top of the Bollinger Band, came back down. Are we seeing that again? Well, we've got a bear signal here on the RSI divergence indicator, but like we've seen a lot of these throughout this cycle, late 2023 and into 2024, and we just kept going higher. So you got to give this market the benefit of the doubt. I've drawn some trend lines here. We lost it, came back up, reclaimed it. So we're about here. You got to see which way we're going to go. But we are toward the top, curling down on the MACD, some bearish divergence on the RSI. We might be due for a breather here, but let's see. Hard to get a breather when we just finally get what could be a higher low or a break above, breaking out of this symmetric triangle or descending wedge or bull flag, whatever you want to call the Nvidia pattern. Strongest stock that has led this cycle higher, this secular AI bull run. If Nvidia is doing well, it's hard to be bearish, even though we had not the best day in public markets. If Nvidia is doing well, if the generals are performing, then the soldiers should too, right? But let's talk about a way you can insulate your portfolio. This was a 5-day trading period, late September into the first couple of days, several days of October. S&P 500 was down less than 1%. So how could you have hedged? A put option wouldn't have done the trick. You don't want to go short here because the market has shown so much strength. Just position yourself for the oil trade and the volatility trade. 8% for crude oil, and we're up even higher since this period. And a 31% increase for volatility. And you could say, well, sure, hindsight is 2020, but how could we have ever predicted that? Okay, fine. Energy trade's always challenging. It would have been challenging to get into that oil positioning. But what do we know about election years and volatility? We move structurally higher from summer through October into November, and then we come back down once we get clarity. So this is a trade that would have been very easy to replicate, that could have hedged your portfolio without you having to get out of any positions. You can remain positioned for upside because you want to be positioned for upside. We're in a secular bull market here. But you can get a hedge through volatility based on replicatable structural historical data. And lastly, looking at the positioning, utilities has been one of our favorite trades over the past year or so. This is from about a week ago. So, this is ironic because when you get this many standard deviations above normal, then you start to think, okay, utilities is probably due to pull back here. And we've come back down by at least a handful of percent in the past couple of days, including, I think, down a 1.5 full% today, which interesting action for utilities. Excuse me. Boy, I'm not going to edit that out, so you're going to have to deal with me coughing. Um, but okay, energy and real estate sectors that we do like, you like to see this if you're structurally bullish because this is going to create an unwind. Shorts will have to cover. Fund managers that are underweight are going to have to buy to get back in. So, hey, flip the proceeds from utilities and bonds into something like energy. Not the worst idea in the world. And here's my point. Energy unwind. Was this from the end of September? Negative 40% on the cumulative US net trading flow for energy. I mean, that's about as underweight as you can possibly be. So if it starts to show good performance, think about the amount of people that are going to have to get back in, get this back to a mean reversion. We've got a lot of upside for energy, and maybe that's part of what we've seen so far. Okay, that's a few ideas for now. Back to this conference for me.